Hello, hi everyone. I'm Shekhar from Momentum Lab and welcome to our channel. So far, we have covered a lot of content around momentum investing. We have done some rigorous backtesting. We detailed the best practices in momentum investing. We've also introduced you to good practitioners in this field. And we also did deep dive a lot of academic research papers on momentum investing. Now, we felt it is time to move on and think beyond momentum investing and see the other factors. Now, it is important to understand other factors because it helps get a perspective which is different from what we've already are well familiar with. This will open our horizons. Now, after opening our horizons and seeing a broader picture of what all investment modes are available, what all different styles are available, then we'll be able to appreciate better even momentum investing and also other styles of investing. Maybe then we can do a mix and match, or we can find a different ways of constructing our own portfolios. So that is an age-old practice called as Purva Paksha, where you not just see your point of view, but also see from the lens of other practitioners. Thereby, you get a holistic perspective. So what I'm going to do is I'm going to start a series of episodes, and in these episodes, I'll be detailing it out each factor. Let's say we'll start with value and then move on to low volatility and then to alpha and then maybe to quality and then some other factors. Now, within each factor, I'll be again breaking down into multiple parts. We'll first start with the methodology. How is this factor even constructed? Second, what is the academic backing internationally as well as in Indian context? What has been its performance? We'll compare it against standard benchmarks and see how did this index or factor perform. And then finally, we'll see its flaws, its benefits, and we'll come to a fair bit of conclusion about how this factor works, what are the periods when this will not work, etc. So let's begin our first episode on value. Now, most of you have been asking about value strategy, and that's the reason we have started first with value as a strategy. Now, before I begin, I would like to first give the academic definition of what a value factor means. So, at the core of value strategy lies the difference in perception. So, market gives a particular price to a stock or an asset class. But as investors, we have an opinion that this price is not the true price. It is actually undervalued, or it is overvalued, or it is fairly valued. So, this difference in perception is what creates the value, or in general, that's the core essence of a value strategy. So if you feel strongly that there are a set of stocks which are undervalued, then let's say you accumulate or you buy them, these undervalued stocks, and you hold. And whenever these stocks appreciate, you sell them. Whenever they are, let's say, fairly valued or overvalued, you sell them. And that's how the factor of value is created. So that's the basic academic definition of buying something which is cheap and selling which is fairly priced or highly priced. Now, the perception between what is fair and what is not fair is subjective. There are different ways one can perceive a fairness of a particular stock. One can use price to equity ratio, one can use price to book ratio, or you can also use price to sales ratio, or sometimes dividend yield also as a metric to measure the value. Then there are some own custom metrics also that you can devise to calculate the intrinsic value. Many of these practitioners use the discounted cash flow and calculate the intrinsic value, what is its fair value, and then see what is the market value. If there is huge variation or deviation, then they say that these stocks are undervalued or overvalued, and then based on the decision, they invest. So let's keep it simple. The academic definition considers one of price to equity, price to book, or price to sales, or sometimes dividend yield. So even our NSE, the major index provider in India, as well as BSC, they base their definition of a value index based on these four parameters, namely price to sales, price to book, and price to equity, and dividend yield. So in index, at the index level, we have four indices dedicated to value, three in NSE and one in BSC. NSE has Nifty 200, Nifty 50 value 20, Nifty 200 value 30, Nifty 500 value 50, and BSC has something called as BSC Enhanced Value Index. Now let's see how these four indices are constructed. What are their methodologies? If we talk about Nifty 500 value 50 and Nifty 200 value 30, they have four submetrics like we discussed. And each of the submetric is given equal weightage. And when you give equal weightage to all these four submetrics, you get a final outcome, and that outcome is called as a value score. Now, each stock has a particular value score. Then you sort all these stocks based on this value score and pick the ones which are cheap or which are meeting the criteria. Or let's say if it is Nifty 200 value 30, then they pick the top 30 stocks based on their relative cheapness. So if you look at the Nifty 500 value 50 and Nifty 200 value 30, the 25% weightage is given to book to price ratio, 25% weightage to earnings to price, and 25% weightage to sales to price, and 25% to dividend yield. Now, please note these are all inverse of what is usually used. So we usually use price to book, price to earning, price to sale. So if the price is nothing but the market price. If the price to earnings is a higher number, it means that it is overvalued, meaning the market price is much more than what the current company is earning. So if you take inverse of it, then it connotes differently. So if the inverse, that is, let's say instead of price to book, if it is book to price, and if the book to price value is higher, then it means the stock is relatively undervalued or cheap. And a lower book to price means the stock is overvalued. So once you combine all these four, then you get a value score, and that's how the index is created for Nifty 500 value 50 and Nifty 200 value 30. So far, fair enough. Even the BSC value index, enhanced value index also is created in a similar fashion. So they take these three matrices, which is book to price, earnings to price, and sales to price. There's no dividend yield. That's how the BSC enhanced value index is created. If you want to take a look at the methodology of different indices, I'll share this in the YouTube description. You can go ahead and check the methodology. It is very important so that we know what we are investing into. If you do not know and just go by blind the name that it is a particular momentum strategy or value strategy, if you do not know what is its composition, how is it constructed, then it is problematic. Let's see the Nifty 200 value 30. Like I mentioned, Nifty 200 value 30 has these four parameters, which is earnings to price, book to price, sales to price, and dividend yield. Then they calculate the Z score. Z score is nothing but, let's say for each stock, you get a particular value score. Now they take the average of all these value scores of, let's say, 200 stocks. Then they calculate the standard deviation amongst these value scores of these 200 stocks. Let's call that as sigma. The mean is mu. Now each value score of a particular stock, from that you subtract the mean and divide by the standard deviation. That's how you get the Z score. Don't bother much about how these Z scores are calculated and etc. Simply, it is sufficient enough to understand that the value of a particular stock is derived from these four submetrics, which is book to price, sales to price, earning to price, and dividend yield. And the weightage is also, I've just mentioned, it is 25% each. Well, let's go back to our slide and then see how is Nifty 50 value 20 created. Nifty 50 value 20 is created in a different way. It has a higher weightage, around 40% weightage to ROC, which is nothing but return on capital employed. 30% weightage to earnings to price, not price to earnings, earnings to price. 20% weightage to book to price. 10% weightage to dividend yield. See, ROC is not actually a value metric. It is actually a quality metric, because nowhere we are comparing the relative value of what the market says versus what we perceive. It is just giving out the efficiency of a company to churn out returns on whatever capital that it is deploying. So you could argue that it is purely a quality metric and it is not a value metric. So that's the fundamental flaw between difference between, not a flaw, fundamental difference between how the indices, value indices of Nifty 500 value 50, Nifty 200 value 30 versus Nifty 50 value 20. So 40% weightage actually is not towards its valueness, but towards its qualityness. And these indices are rebalanced once in 6 months. So what happens at the end of 6 months? Let's say you've listed all the stocks based on perceived valueness. And if a stock has gone below the value score, then you exit that stock and you pick another stock which is high in value. Now, how do you define high in value? If the stocks, if these values are high, then that's how the value score will be high, and that's how this stock will get picked. Now, so far we've understood the mechanics that these four are the ingredients that I mentioned: book to price, earnings to price, sales to price, dividend yield. These are the driving factors whether a stock is perceived to be value or not. In Nifty 500 value 50, Nifty 200 value 30. In case of Nifty 50 value 20, it is ROC which plays the predominant factor, and then comes the earnings to price, and then book to price, and then dividend yield. You can also argue that dividend yield, in a true sense, is not a value metric. It can be a quality metric. Like a good quality company usually churns out. Quality again is a perception. How do you define a quality? Whether it can be ROC, it can be in terms of its management quality, whether it can be in terms of the dividend yield. So some consider dividend yield to be a quality metric. Some consider it to be a value metric. For its benefit of doubt, let's give dividend yield as a value metric and just only consider ROC to be a quality metric. Now, once we've understood the methodology of how these value indices are constructed, let's see one of the fundamental flaw in the way these indices are constructed. So for a moment, let's assume that you've invested in a index, Nifty 500 value 50, which has all the top 50 stocks which are perceived to be cheap or having value. Let's say these stocks starts to rally up. They go berserk. They increase the price of these stocks are going rapidly. And after 6 months, you see that, let's say, these stocks have doubled, just for the sake of example, or they've gone up by 50% or 60%. Now, what happens when these stocks price goes up? Obviously, this submetric, this value will come down because the market price, the P is in the denominator. This price has gone up, thereby the book to price ratio will come down. If the book to price ratio is coming down, then 25% weightage is to book to price. The price is also in earnings to price. The price is also in sales to price. The price is also in dividend yield, because the denominator in dividend yield is dividend divided by the price. So if price starts to go up, then all of these submatrices, these values start to plummet. Now, what happens when the values start to plummet? The value score will come down. If the value score comes down, then during rebalance, this stock is naturally exited. So you see, if a stock's price is going up, then the value score comes down and the stocks get exited. Now, what kind of stocks are picked up again? The stocks which are having higher value scores. Value scores again are derived based on these four metrics. Okay, so far fine. We are exiting stocks which have run up. So we might have made certain good money during this rebalancing period, and during this 6 months of rebalancing period, and that's fine. That is, in a way, contrary to momentum investing, where we let our winners run. In the case of momentum, if a stock starts to rally up, then its momentum score goes up. If a momentum score goes up, the momentum score is basically its last 6 months or 12-month returns, take an average, and we calculate the momentum score. If its score goes up, we continue to hold again and check after again 6 months. If in the next 6 months also, if it is still performing well, we continue to retain. So we continue to retain it until its full steam is seen, or we see its full potential of run. Whereas in value, do you notice that the moment a stock starts to rally up, automatically it gets kicked away, unless the earnings or the sales or the book value proportionately also increases. So in the case of stocks which are, let's say, are driven by some news or some external happening, but fundamentally nothing has changed. So these stocks are kicked out from the value strategy. But yes, they might be still coming up in momentum, but the value will kick out, because fundamentally there is no change in its inherent intrinsic value. Just the price had rallied. So because of that, we are exiting. Fair enough. This is okay. Let's see the other downside. When the prices starts to fall, what happens? If prices starts to fall, then again go back to the formula how a value score is constructed. If prices starts to fall, then since prices is in the denominator, then the book to price value will go up. Thereby, the 25% weightage to book to price value will go up. Same is the case since the price is in all these matrices. The earnings price will go up, the sales to price will go up, dividend yield will also go up. So if a price continues to fall, then the value score of that particular stock will continue to go up. Let's say after 6 months, the price of a particular stock has gone down by 50%. Then the value strategy or the value index will be screaming to buy it more, or will be screaming and will be giving it a higher rank because the perceived value is even more higher now. And after another 6 months, let's say if it goes even further down by 20% or 30%, the value index will love it because its perceived value score is even higher. Now compare that with momentum strategy. In momentum, if a stock is falling down or has given its run, at the end of next rebalance, that is 6 months, we'll calculate the momentum score. The stocks which are having obviously lesser run are kicked out. So there is an inherent risk protection mechanism in a momentum strategy where you are cutting the losers early and letting the winners run. Whereas in value, it is quite opposite. You are cutting your winners early, but letting your losers run. So it is quite opposite of how momentum strategy is constructed by these indices. Please bear in mind, other people or other investors or other investment managers might perceive value different and they might have a different exit rule. So I'm just talking about the NSE and BSE indices and their fundamental flaw in the index creation. And this flaw is there. It doesn't mean that the NSE should not publish this index. I think it is their responsibility because this is how the factors the academia has defined a value factor. So they have gone ahead and published it. Even AMC also publishes an index based on this uh, particular value index. Again, there's no wrong. If an investor goes and buys blindly without knowing what is the methodology of how these indices are created, then that is a mistake. So it is not the mistake of the NSE or BSC, not the mistake of the EMC. If it is the investor is at the blame, if they do not know what they're buying, what is the ingredients or the methodology beyond which they are constructed. So you're getting the drift, right? So value strategy, if the price goes down, we love it. If the price goes up, we don't love it. So we'll see only a small bump or bouts of run in a value, and that's it. So that is what I've noticed when I presented last time. If you remember, I had shown the 1 year rolling returns of different strategy indices, low wall, momentum, quality, and value. If you notice, actually, pay close attention to the value strategy, which is in green color, 1 year rolling returns. So this, if I actually show it in this way, it will be even clear. See, the green colored lines are dominating in every bull run. The green color lines are nothing but Nifty Value 50. It is even dominating the momentum and other strategies. So during a short bouts of run, they do fantastically well, the value strategies, because because they are the first ones to pick these undervalued stocks. They get the first full run. And that's why you see during these bull runs also, I think during these bull runs, the green is overshadowed. Again, see here in 2014, 2015, the greens are overshadowing all the strategies. Same with 2016, 2017, 2020, 2023, 2024. And notice the downside also. They are the first ones to lose because there is no inherent risk protection mechanism. Because they continue to latch on the losers. If a stock is going down and down, the value score increases and they continue to keep holding them. And hence, while they go up, frantically up, they also go down. In every downturn, they are the worst performers. See 2013, 2014, 2015, 2016, 2018, 2020. So they go up and they go down in the same fashion. Thereby, they are not a consistent performers. Unlike momentum. Momentum, they are a consistent performers. Leave about momentum for now because I'm just giving you the perspective of momentum because you understand when you juxtapose value and momentum, you see that it is quite diametrically opposite of value. That's why I wanted to just give a sense of how this value strategy is constructed and the flaws or flawbacks in the strategy. You also see the summary. Like I showed in the last time, right? The bottom 25th percentile of 1 year returns is at minus 9.4 compared to all the other strategies which are in positive territory. Meanings, meaning that it goes up and in bad cases, it gives up that whatever run it had had. And thereby, it ends up being just above the market index and fairly below momentum and also even below low wall and quality in terms of performance. This is purely the NSE and BSE indices I'm talking about. Let's also take a look at the differences between Nifty 500 value 50, Nifty 200 value 30, and Nifty value Nifty 50 value 20. See, in the case of Nifty 500 value 50, the problem is, let's say a stock from Nifty 50 has come into the Nifty 500 value 50's radar. If the stock's price keeps on falling, it will obviously move away from the Nifty 50 index to Nifty Next 50, maybe to Nifty Mid Cap 150, and eventually to Nifty Small Cap 250. It will take considerable amount of time for it to finally get exited from Nifty 500. So that much amount of leeway is there if you are picking a Nifty 500 value 50 index, because there is less downside protection. But see the inherent advantage of Nifty 50 value 20. The Nifty 50 value 20 is, well, yes, it loves stocks which are going in price. There's a cap of 50. The moment it goes below 50, it is out. It is not even Nifty 50. So it is not even considered as part of Nifty 50 index. So obviously Nifty 50 index with whatever stocks are there, from there only the Nifty 50 value 20 is derived. So that inherent risk mechanism is there in Nifty 50 value 20. I'll show the performance of Nifty 50 value 20, Nifty 500 value 50, Nifty 200 value 30 in the next video. But this is the inherent risk protection mechanism of Nifty 50 value 20, that it protects the downside. And Nifty 500 value 50, that downside is not there. To a certain extent, it is there in Nifty 200 value 30, because the stock, let's say, even though it is in Nifty 50, it might go down to next 50 and then to Nifty Mid Cap 100. And eventually, if it's still falling, it might exit from Nifty 200. But still, at some point of time, you'll exit that stock, even though the perceived value is increasing. At one fine day, it is so great in value that it is not even in the index. So that's the irony of Nifty index calculations of the NSE. That is one risk inherent protection mechanism. The other risk protection mechanism I see in Nifty 50 value 20 is the 40% weightage to ROCE. So this is actually not a value index like I described last time. It is a quality index. So if a price is falling drastically, frenetically, but if there is something fundamentally broken also, that the ROCs are also falling, then you get a exit call. If the ROCs are not falling, if the ROCs are stable, but let's say the price is falling down, then that's another case. But the ROCE mechanism is some kind of a filter or a plugin that is made, which gives a cushion to not just rank stocks on value, but also on some fundamental value. This blended mix of quality and value, actually, it should not be called pure value strategy also. It is some blended mix. So this blended mix of putting quality and value is also second risk protection that is giving to Nifty 50 value 20. Most of the people have already noticed and they've already given in comments that Nifty 50 value 20 is a fantastic strategy. It is doing well. So we'll talk about the performance of different value indices in a separate video, as I mentioned. But see the inherent calculations of how these methodologies are created. So if you imbibe these methodologies, then you'll be in a better position to judge what kind of factor indices, and within the factor indices, which ones are right for me. So I'm not a SEBI registered advisor. I'm not giving any recommendation between these 3 or 4 value indices. I'm just laying out the methodologies. Please take your own consideration. I try to detail it out as much as I can in terms of a DIY investor, but obviously you can do even much more research than me. In the next video, we'll do performance of these 3 or 4 indices and compare it with Nifty 500, Nifty 50 and see how they have performed, when they have performed, when they have not performed, what is the volatility, the rolling returns, etc. So at the last, I just want to highlight that the key flaw in NSE value index construction is its love affinity for falling knives. So be aware of it and know when to buy, when not to buy. So when to buy is during the upcycle. So every dog has its day, Same like how we have seen the rolling returns where value does fantastically well, right? So it has its cyclicality. If you're able to master that cyclicality, you'll get an outsized return in a quick span of time. And when that comes, no one knows. If you're master of it, then nothing like it. That's the key takeaway from our first episode of value strategy. Stay tuned. In the next episode, we'll do performance comparison. Thanks a lot. Have a nice day, guys. Bye.